Hey guys, how's it going? Value Venture Investing here today. So today we're going to be talking about the difference between market capitalization, also known as market cap. I'm going to be referring to it as market cap, versus value, or as some people might call it, intrinsic value of a stock. Wow, I think this is a topic that is confused so much by the general public. It's confused by new investors, young investors, people that are just getting into it. So I wanted to make a video about this because I've been thinking about it a lot lately, especially some of the stocks that I've seen and the arguments that are being made for the valuations. And so I want to make it clear that these two are almost used interchangeably sometimes. They'll say the value of the company, which is kind of true. The market cap is kind of the value, but true value is actually something different. So they are a bit distinct, even though these terminologies shift back and forth. So the first thing I want to talk about is, what is market cap? So if you don't know, it's price times the number of shares outstanding. Now, if you're not too sure how a company becomes a publicly traded corporation, I'm going to put a link right here, right now, on my video as to what is a stock. But to give you just a quick rundown, when a private company needs to generate more cash, we're going to be doing this very basic. I'll make a lot of assumptions here, but say they want to generate cash, they need more cash, they can go public and issue shares. So for example, they could go to an investment bank. This is a very small example, of course, but issue 10 shares at $10 a share and have $100. So proceeds, right? And then they have 10 shares outstanding. So their market cap in that case would be $100. Their price would be $10, and the number of shares outstanding would be 10. And that's set from pre-IPO when they go public, right? And it doesn't necessarily mean that's the value of the company. Quite often when we hear about companies going public, that is what it is mentioned as the value, but it's not necessarily the value, because it's kind of just like the price that they could get. That's how many shares they could sell, and at the price they would get per share. And of course, investors are going to looking at their earnings and stuff like that, but it's not necessarily the value, right? So let's look at each one of these components individually. What is price, and what is number of shares outstanding? Price, as we know, is something that is supply and demand related, and it's mainly driven by sentiment. As soon as those shares hit the market, they can go up in value, they can go down in value. All things remaining equal, there could be absolutely no change to the underlying fundamentals, the financials of the company, and the shares could go up. They could go down. It could do with economic factors, but in most cases, it's to do with future expectations. So if the company comes out and says they're uncertain about the future, generally speaking, the prices are going to go down, the price is going to go down, and therefore the market cap is going to go down. So there's many factors that come into play, and now you're probably already seeing why market cap is not really a true metric of value. In terms of the number of shares outstanding, that can be manipulated as well. Of course, that's set on the preset from the beginning when they issue the number of shares. However, companies can buy back shares, right? So they can take out the number of shares outstanding. So that could, all things remaining equal, if the price didn't change, changes the market cap as well. They can also issue more shares. Same thing there as well, right? So both of these things are dynamic. They're not static, right? And that's what you get to the market cap, or market capitalization. Quite often the market capitalization is described as the value of the company. So it can make sense in terms of that's what investors value the company at. But it's not necessarily the intrinsic or the underlying value, if that makes sense. So I have one example here to try to make a little bit more clear for you guys. I'm not going to tell you what the companies are right away. These are real companies, all real data here. As of recording this was accurate. Of course, it's going to change second per second, the price, right? And we're going to compare these two companies. If you know much about finance, you probably know what these companies are already, but I don't want to focus on that on this video. So the first one has a price of $119 per share right now, as of recording this. They have 17.1 billion shares outstanding. Same formula as here, guys, right? So price times the number of shares. They have a market cap of $2.02 trillion. Huge. So you already probably know what this one is as well. So over $2 trillion market cap, not value. TTMNI, you're wondering what those acronyms mean. That means trailing 12 months net income. I'm doing this at the end of 2020, so I wanted to kind of keep it as updated as possible. So I'm just doing the last 12 months because we don't have the full year in for most of the companies, right? So we can compare the same thing on both companies. So the last 12 months net income, huge here, $58.4 billion. So that's, if you don't know what net income is, I'll put a link to that video as well. I have a video on that on my stock market basis as well that describes that, but basically that's what they're going to be earning in cash, the bottom line. It's a little more complicated than that, but basically what they're earning, not the revenue, their net income. Earnings per share is $3.28 per share. How do we get to that? Well, we take the earnings of the last 4 quarters and we divide it by the number of shares outstanding, and we get the earnings per share. You've heard me talk about the PE before. This isn't directly related to what we're talking about, but it gives you a good idea of how values are different on these two companies. Now, I'm going to put this on the screen right now. PE is the stock price divided by the earnings per share. So, stock price in this case being 119 divided by the earnings per share would give you roughly 36.3 times earnings. Now, what does that mean? PE, what does that mean? That basically tells you what you're paying for $1 in earnings. So for example, in this company, for $1 in earnings, you're paying $36.3. So it's very quantitative, not qualitative. It's value, right? This is the earnings that the company is making, and how much are you paying when you buy one share, because those earnings divide through all the shares. For that $1 in earnings, how much are you paying? You're paying $36.30. So it's a good measuring tool there. So next one we have here is price of $567. The shares outstanding are 947 million, a lot less, and their market cap is $538 billion. Their trailing 12 months net income is $556 million. So it's like just over $500 million versus $58.4 billion. Huge difference. Their EPS is 52 cents per share, and their PE is 1,085. So for every $1 of earnings, you're paying over $1,000 for that. And you're wondering, why do people do that if you're new to the stock market? A low PE would be like 10 or below 10, something like that. It's because that company is going to grow in the future. It's going to pay dividends, so you're never going to pay 1-to-1. You pay for future expectations, right? And so the higher the PE, obviously, the higher the expectation is in the future. So this might not tell you a lot looking at it this way. So I broke it down in this way. So this is company A here. This is company B. This is company A, and this is company B. So company A has net income. Well, let's actually do that the other way. Sorry. Because I put them kind of backwards. This is company B, right? We'll put B here, A. This is company A. This is 536 billion. So this is company B and A. So company B's net income is 556 million, like we said. Company A's net income is 58.4 billion, as we said here. So you can see that companies B's net income is less than 1% of company A's. I'm just going to tell you the companies to make this a lot more easy. Of course, A is Apple here, Apple, and B is Tesla. So we'll write those in here now that I'm going to tell you. I didn't want to make it about the actual companies. This is Tesla. This is Apple. This is Tesla. This is Apple. So make it a little bit easy. So yeah, less than 1% net income. So actually earnings that they are earning that are going to their bottom line is less than 1%. It's 0.952%. However, their market cap is 27% of Apple's. So that shows you the difference, the contrast between the actual value, the earnings, and the market cap, the disconnect. And you're wondering, well, why is that? I obviously have my personal opinions on it. I'm not going to make it about this in this video. But it's because future expectations are very high, and people think that this company is going to do very well. But in terms of value, Apple undeniably is cheaper. I mean, there's no arguing that. However, a lot of people might make the argument that we should look at companies based upon their market cap. We'll get into that in a second. So in terms of the earnings per share, if we circle this here, earnings per share, we're looking at about over 6 times on Tesla, if they had about 6 times the EPS, then, all things remaining equal, that the share price stayed the same, we'd have the same EPS, but they'd still be trading at like 170 times earnings, and things get normalized over time, right? The PE goes down. So whether or not, that's what you got to think when you're investing in these companies, whether or not that's going to be happen is the question. You have to quantify that with numbers over long periods of time. However, lately it seems to be more speculation based and people aren't actually looking at value. And I'm not making an argument that Tesla can't do this. Personally, I think it's overvalued. In my opinion, I think Apple is undeniably undervalued. But that's not that, don't dislike this video. That's not what this video is about. I'm not trying to make that argument. I'm just trying to show you that in terms of value, there's a big difference. And we see this a lot even in the news. We see people talking about, Amazon increased by this amount, Tesla increased by this amount, and people still think that they actually made money. They made more money. We can have these wild swings in market cap because price changes drastically. And the media will report it as Amazon increased in value by this much, and people are like, wow, look how much money they made. So that can show you the difference, that that's not value. Money is value. This is market cap, right? So I hope that made that clear for you guys there. If you have any questions, leave a comment down below. I just wanted to pound that into you guys to start thinking of it that way. And I'm going to be doing more videos on just the basics. This is my stock market basics videos, the difference in value and market cap and different things like that. But in summation, they're kind of interchangeable terms, but they're different. Market cap is just the expectation. It's what people in the market, which could be institutions, individual people, whomever, believe that the company is worth, or that they bid it up to. There's actually one thing that I left out. That changes in prices can be even increased by things like short squeezes. If you don't know what a short squeeze is, we're not going to get into that. But basically, people can bet that the stock's going to go down and borrow shares. And if the stock keeps going up, the broker will go, wow, you need to give me money to make sure I'll get my money back here. This is very simplistic. And if they don't, they'll have to liquidate and buy back in. And if enough people do that, it can drive the price way up and has nothing to do with value. In fact, those people think that the stock's going to go down. That's why they shorted it. However, they're helping driving the stock price up. So that's just another example there. So back to what I was talking about. Yeah, so they're not, they're not the same thing, although they're treated as the same thing most of the time. And it gets very dangerous when I see people, even big YouTubers, looking at market caps of companies, I won't mention any names here, and saying this company should have a similar market cap to this company over here. And because of that, they should have this price. You can probably already see the issue with that. Market cap is price times number of shares outstanding. So it's almost like they're working backwards and saying, well, I'm going to give it this price, so it has to have this price. There can be some validity to that in terms of just comparing what the sentiment is on two companies, but they have to be very similar because there's a lot of differences in the individual items. And to make an argument in terms of the value of a company based on something that actually really isn't even value is totally wrong in my opinion. So that's something to be very careful with, and I see that a lot with young investors, like a ton, and that's what really prompted me to make this video. In terms of value being intrinsic value or value, that can be subject as well. So for example, subjective, the price of Apple at $119 per share could be the value of it. But if you look at in terms of intrinsic value is going to be looking at metrics like their earnings and stuff like that and discounting it back to present value to determine a price. But you got to keep in mind there's still many factors in this. There's sentiment involved. So the actual intrinsic value might be different than the actual price. But in terms of their actual value, if you look into the actual what they're making and value it on something like a PE, there's not much argument. I mean, there's argument in terms of using PE as an investment tool, but there's no argument in terms of this is a quantitative factor rather than a qualitative one. You know, it's not subjective. It tells you what the value is. So again, guys, hope that was clear. If you have any questions, leave a comment down below. I'd love to hear them. Don't forget to subscribe, and I'll see you in the next one.